The final angle I'll put on this to scare some of the people listening, if they are protocol operators, is there's also a legal side to this, right? TradFi people, governments, regulators know what front running is. This is something that exists. It's looked upon as being illegal in many jurisdictions. I believe Europe basically just try to just say MEV is straight up crime.
This episode is brought to you by Renaud Partners, the premier go-to-market advisory firm for early-stage crypto teams. Thanks to them for making this episode possible. This episode is brought to you by Ledger, the most secure hardware wallet trusted by 7 million users and securing 20% of the world's digital assets. We'll be hearing more from them later in the show. Hey Lightspeed listeners, we need your help. Lightspeed is conducting an audience survey to help us get a better picture of who our listeners are and what you want to see from the show. Think of this as our annual review. What do you like about the show? What could we improve on? If you want to contribute, visit the link in our show notes to fill out the survey and help us make a better show for you. Hello and welcome back to another episode of Lightspeed. I'm your host, Jack Kubanak, alongside Mert Mumtaz, and we're very lucky to have former Lightspeed host, Blockworks data lead, Dan Smith, back with us on the pod. Dan, thanks for coming back on, man.
Pleasure to be here. Always happy to come join the Lightspeed crew.
And congratulations on the launch. This is a little dated now, but the new Solana dashboard went up. It's very pretty. It has more colors. It's much more customizable. And I know you guys are working hard on that for a little while. So congrats. It looks great.
Yeah, I appreciate that. It's available publicly at solana.blockworksresearch.com. Again, that's solana.blockworksresearch.com. We'll put a link in the show notes here as well. I think it's actually in the show notes of most shows. But yeah, huge UX improvement. You can just have way more flexibility over each chart, easier to select time frames. You can toggle between actually seeing the raw data values or normalizing to percentage directly within the chart, things of that nature. So just like a big user improvement. The second part of the work we're doing is just improving like our data infrastructure backend to be able to just handle more robust analyses. So things like looking at what programs are driving REV over time. Right now we show that on like a rolling 24-hour basis, but the reality is they're doing that computation on a longer time series. Is a challenge because there is so many Solana transactions. So yeah, we're just like building out the back end side of things now.
Are you worried that as like, TPS go up and this sort of thing, that it'll be difficult for the research dashboards to handle all the Solana data?
Yeah, I think it was 0x Osprey who created the legendary meme for this, which is the black and white picture of Anatoly with just "fuck them indexers" right on top of it. So yeah, these are the problems. Yeah, these are the problems that keep Mert up at night. 1 million TPS sounds great until you're the one who's got to collect the data, clean the data, and run the analyses on that.
Dan, one of the things that is always fun to see from you is I feel like you're one of the elite noticing things on the blockchain people where I remember Uniswap Labs turned on its fee switch or something quietly, and you noticed this a number of months ago. And you do things like this regularly. And one of your recent ones that was has been making the rounds on Twitter was you noticed that a certain Solana bot did like 800 billion in volume over a couple of days, and this it looks like turned out to be a wash trading bot. So I'm just curious to hear the story about that discovery and maybe some of the takeaways from what you saw.
Yeah, absolutely. So the reason how I end up seeing these things is I have like a lot of charts built out across a large number of chains that are tracking key metrics, anything from something super simple like total transactions or the split between failed and reverted and successful transactions to stablecoin transfer volume to DEX volumes, and like moving all over the spectrum on terms of like what types of metrics we're looking at. So that's actually how we saw the Uniswap Labs one. Like one of the charts just totally blew up, which is generally an indication that something changed. And in that specific case, it was actually a subscriber to Blockworks Research that was looking at one of our charts and was like, wait, this clearly doesn't make any sense. And it was because they previously only took USDC, and now they're taking, whatever denomination the swap was in. So of course that blew up the pricing mechanism we were using at the time. In the case of the Solana wash trading bot that just recently started getting popularized, same thing. Our Solana DEX volume chart just like absolutely exploded. So I check that pretty much every day because I'm like very interested in what's driving the needle on Solana. and right now it's DEX volumes. And so, I logged in and there's just like a $800 billion candle on the most recent day. So I think it was M Team on Twitter. He's like, dude, how do you see this? I'm like, because $800 billion is a huge number. But basically what this bot was doing was, the intention was to create a volume bot. Like, that was very direct what the developer of this bot said. Like, he was like, I don't know, I wanted to see if we could pump volume, and I wanted to see if token price responded to volume. That was straight up the intention here. So the model of this was basically the developer would create his own Orca pool. It's like permissionless pool deployment, and set 0 swap fees, and then take out a flash loan from Margin 5 for like $10 million and swap it through this pool that he had already seeded with a very, very small amount of liquidity. And then in a single transaction, you'd have back-to-back trades to the same pool. So you'd basically swap like 10 million USDC for some super small amount of a token. In this case, it was the Jupe token. And then immediately swap it back within the same transaction, or even the same instruction. And then like that was just creating all of this volume. And of course, the transaction fees on the Solana are very, very low. So there's like very low cost on that side. And then because you set 0 fees to the LP pool, there was like no reason for anybody else to even join this pool and like suck fees out of this, right? Like, you could also, if you're the only LP in the pool, then you get all the fees, so it doesn't matter. But if you're moving all of this volume through a pool and you have fees, I can assure you that other people will come join that pool. So this was basically the idea. So now we filter out pretty aggressively based on the minimum fee of a pool. Like basically anything under 1 BIP, we're not counting as volume right now. You could definitely get stricter on this and look at the number of LPs in pools or things of that nature. But yeah, it's been a fun challenge trying to like curtail this.
And the guy who took credit for the wash trading bot was the same guy that like exploited Pump Fun back in May or whatever it was, and I believe got arrested in London. So that was an interesting, like, oh yeah, I remember that guy. He's back doing
just on the blockchain doing crazy shit. His name's Stack Overflow. He's got a very interesting Twitter if you're so inclined to follow. Yeah, I walked through a transaction as well in one of the tweets that I put out. Maybe we can probably put a link to that in the show notes as well. And again, you can just kind of see like this transaction structure is take out giant flash loan, execute swap, and then swap it all back, and then return giant flash loan. So you're taking on no risk and doing this at only the cost of a transaction fee, which again is just very low. So on cheaper chains, you're going to get people doing dumber shit, which makes the challenge of meaningful data analysis just more complicated. So I think it's like interesting to bring this back up because Mert, you and I were chatting the other day, and I just saw Hasib from Dragonfly kind of ask this question on Twitter earlier today, which was they were looking at stablecoin transfer volumes, and they were doing these flash loans in USDC. So the stablecoin transfer volume chart is like insane. Again, there's this $800 billion day of volume, and it's like wash trading volume. And like now you get into the even more complicated piece of like doing the data analysis on this. It's like, those tokens did move on the blockchain, but that's not really what you're trying to capture with a stablecoin transfer metric. So it's thinking about like more rigid ways to filter down that to get like something that mimics payment activity or just like real DeFi usage, like someone depositing into Camino. Yeah, that's like a stablecoin transfer. But that is kind of funny when you compare, I don't know, I think it was like Nick Carter and like the Visa team and Allium, like they do like try to do these like rigid analyses of the adoption of stablecoins on chain, and transfer volumes are always a part of that. But now once you start like seeing like what's kind of baked into this number, and people are comparing stablecoin transfer volumes to like, the amount of money that Visa processes in a year or whatever, it's like, yeah, like that's true, but we're also doing really dumb shit on chain with this. But that's not to say people aren't buying dumb shit with credit cards either.
Very true. Obviously, Dan, you can see, 800 billion in transfer volume, something fishy is going on here. But just for like the average person on chain, average trader, or even like crypto professional who's not super deep into the data world, how do you avoid just getting fooled by all the crazy data noise that's out there?
Yeah, great question. I mean, look, like basically every single metric is gameable in some capacity, right? Like your first question when you see an anomaly in data should not be like, holy shit, look at this growth. Like that should never be the first reaction. It should always be why? Like what's the driver? And then you take that one step deeper, and 9 times out of 10, you're gonna be like, oh, like X, Y, and Z was happening. And it's always something interesting. Like even in the case of this wash trading bot, like still interesting. I still want to know why that's happened. Like what's the motive here? Is this going to continue going on in the future? Is this actually like a sustainable growth thing? Like I would say no to basically all those things for this case. But even then there's like incentive programs like ZK Sync Era is doing their Ignite program that just launched, and same thing. Stablecoin transfer volume like went through the roof, and it was all deposits and repays through like 2 lending protocols that now have incentives. So it's like, okay, like that's like moving the needle, and you do want to analyze that. But the question is always why. And honestly, like this is not to shill the metric here, but like this is why I bitch and moan on Twitter about REV all day long, because it's the one thing that like is the like solid answer to what's the growth, what are people doing. It is the monetary demand to transact on a chain. This is why we REV. Like this is literally why. It is a much harder to game metric. Like if you think about Solana, like okay, every validator could choose to spam their own blocks. But then they'd have to pay the burn, and like post SIMD96 that can like create an incentive to do this. There's really only one chain that can like technically spoof REV in a relatively sustainable way, which is Base, ironically, just because they are the sole beneficiary of all all net profit that moves through their L2, versus something like Arbitrum, you know, that gets held by the DAO. So the DAO would have to like opt in to do this to distribute the funds, whereas you know technically Coinbase could just sit there and like spam the shit out of its L2, raise the global fee, and everybody pays more. And then like the only thing Coinbase is losing is whatever has to pay back to the L1, which today is not a large number. I'm pretty sure like the OP collective fee is larger than the amount of value being paid to Ethereum at this point, which is pretty interesting. So yeah, that's again, like I think the summary here is just when you see an anomaly in data, like to the upside or the downside, the question should always be why. It should never be, holy shit, look at this. And you're going to get a more interesting story when you peel back it usually doesn't take that much effort either to peel back that first layer. And then again, like this is the value of RAV. It costs money to actually drive this number.
I'll also take a shot at this because, yeah, been working with data for quite some time. And I think, Jack, your question was framed as if you're just not super experienced with data and you're kind of just new and you see this stuff, how do you reason about it? Well, actually, I think, and I've tweeted about this a few times and it's gotten me in trouble, but generally, I would say do not use data when you can use reason, because to use data, you need to know how to interpret it. And unless you're Dan, it's just not going to be very easy for you to interpret it. And so that's, I think, also kind of what Dan means by the word why. It's like, okay, you look at the chart and it just looks like an absolute Burj Khalifa one day, and then it just goes back to, you know, townhouses. It's like, okay, is that an anomaly? What is happening? Why did that happen? Okay, there's an airdrop. So I would say, like, do not trust data in crypto in most cases, unless it's from a very vetted source, something like, so I use Blockworks' research dashboard from Dan. I also do my own queries sometimes, and then I'll ask Dan, hey, is this query correct? Artemis is good too, but like it is very raw in some cases. And so like you have to still see that data, but interpret it. And so I would say just, if I were you, or if I were this new person, let's say it's crypto, first of all, you're probably not going to be able to read the Solana Block Explorer too well. And so I would use first verifiable sources or reputable sources like Blockworks. There's also some common Dune dashboards that we generally link up, or like Jito's Explorer is pretty good as well. And then just use reason, but do not read too into it. And then also understand that cross-comparing chains is very difficult, extremely difficult, because not only do they have metrics that don't mean the same things, but kind of look similar, there's a lot of, how do I say this? It's very hard for somebody to wrangle with all the fake volume on all chains at the same time while being one data analyst. right? And I can assure you that this stuff goes on in basically all chains as well.
Yeah, big plus one there. This is definitely not like, especially, I mean, wash volume specifically. We see this on every chain, right? Like, I don't know how many people listening were in the Canto trenches, but I think that was a great example of like a chain that not embraced, but was in some ways optimized for wash volume. There was like very, very low transaction fees and native decks that had zero swap fees. Like, obviously, this thing was going to have high swap volume. So yeah, big plus one there. Every chain has got its own unique feature set, and we do see this elsewhere. It was not that long ago, I think it was 2 days ago. The base perp dex volumes were getting thrown around, and it seems very likely that one of the top dex perps dexes is just like wash trade volume. I haven't personally looked into too deep there, but it seemed very suspect to say the least. So again, the point being, like, where you have a lot of activity and where you have cheap transaction fees, there will be nonsense on chain. Like, that's just how it works. So yeah, and you're going to see more of that as chains have gotten significantly cheaper over the last 12, 24 months, and there's significantly more activity happening on chain. So we are in a zone where nonsense is ripe.
Everybody knows there's a massive shortage of top senior marketers in crypto, and teams are constantly struggling to get their go-to-market done right. Renaud Partners is the premier go-to-market advisory firm for early-stage crypto teams. They help top founders tell their stories better and build great non-technical teams. They advise founders on all things marketing, tight brand positioning, community building, social media, and building A+ internal teams. They work with some of the top projects across Solana, Monad, Ton, Base, and others. Renaud Partners has built the most elite network of native crypto marketers globally. They create custom expert teams to support founders with transformative strategy work. Some of the best founders, VC firms, and ecosystem leaders in the business trust Renaud Partners to help their teams expedite their marketing success and catalyze their growth. If you're a founder or a VC looking for support for your teams, I highly recommend connecting with them. You can learn more at RenaudPartners.com. Celebrating 10 years of innovation, Ledger remains the most secure hardware wallet for your Solana and logins, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a robust ecosystem of products and services, making digital ownership more secure and accessible to everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, feature the world's first secure touchscreens, making it easier and safer to manage your Solana transactions and coins. With Ledger Live, you can seamlessly and securely manage and stake your SOL. Alongside Ledger Stacks and Ledger Flex, Ledger introduced the Ledger Security Key app, a safer alternative to traditional passwords, enhancing your overall digital security. Thank you to Ledger for making today's episode possible. Okay, so we're on a bit of a data roll here. So Dan, I'm just going to keep you going. You wrote a bit of like a Twitter essay recently about FDV and how it's kind of the wrong way to think about how you can value tokens, because a lot like FDV wraps up in it both unlocked and locked tokens that may never be unlocked. So walk me through your issue with FDV and what is a better way to value crypto tokens?
Yeah, great point. So for L1s, I think this is like a little bit less of the case, but just because of the way their tokens are historically structured, there's nothing specific about an L1 here. It's just the way that that sector's tokens get structured. But really at the app layer, I think this is where it's super prevalent. I think this all stems from Bitcoin being the premier crypto asset and it having this like hard fixed supply. But at the app layer, tokens and equities kind of like blurred together, and they're very similar in a lot of regard. And so for real world companies, you don't see hard capped equity counts. Like, that's not a thing. You issue shares. And you would assume that that same principle applies to, like, I don't know, your favorite DEX or lending protocols token structure, but it doesn't. 9 times out of 10, 99 times out of 100, you have these like hard capped minted supplies where, let's say 20% goes to the team, 15% goes to the investors, and then the rest is like, let's say 20% to an airdrop, and the rest just sits in a DAO treasury. Well, it turns out the tokens sitting in the DAO treasury like don't exist. If you're building out rigid financial statements, Those are not assets on the balance sheet. Those are unissued shares that have been authorized to be issued. And that is a very important distinction because, again, 99 times out of 100, those will not be issued, right? I think Arbitrum's a really good example here because it has a reputation of being a DAO that aggressively spends. It did $160 million of spend last year in token issuance, and much of that was pointed at like incentive programs that didn't drive a ton of traction, and that's why it has this reputation. Well, if you look at the circulating supply today, only 6% is from DAO spend, which is not a huge number. And they still have about 80% of their total allocation left unspent. And the DAO has now kind of like realized that, hey, holy shit, we spent a lot of money. Like, we really got to cut back. And it's gotten super strict. And if you are an analyst trying to make a reasonable valuation model for Arbitrum, the token supply is going to be something that, like, that's your denominator in this piece. And so this is where it gets interesting on, like, from a valuation perspective, how do you treat the supply numbers? And so basically the reality is using FDV is super easy. It's quick, it's dirty. You can just pull up, the total supply, multiply that by the price, boom, you're done. But if you actually wanted to build something a little bit more rigid, the issued supply is really the important number there. So basically you can take a couple different views here, but the view that I'm kind of like playing around with right now is just count the foundation as part of the circulating supply due to general lack of transparency across the board. Not talking about any specific team here at all. Like, just if anything, at best, you get like a 12-month lag on foundation tokens. So as those vest, treat them as part of the circulating supply because the foundation is like, their mandate is to use those tokens to benefit the protocol. And then anything that's been issued to investors that is vesting, that's part of the issued supply. Anything that's been issued to the community in any regard, part of the issued supply. And anything sitting unissued in the DAO treasury is just not a relevant piece of this puzzle. If you're trying to build like a maximally rigid, maximally accurate model here, you would project out, let's say you had a hold period of 3 years, we have to make some assumptions about how many tokens will be issued in the next 3 years. Of course, now this gets into like a little bit more of the complex territory, which is kind of like any analyst should do that, but we're trying to create, a standard metric worth looking at, which again is issued supply. So TLDR is you're really just removing the unissued tokens sitting in the DAO treasury that are not part of, they're not assets on the balance sheet. They're not used in any regard. They don't exist yet. And that's just the key distinction here. And so, yeah, this is really more from a valuation perspective than anything else.
So how should this shift the kind of conversation surrounding low float, high FDV tokens? Because I know when it was in the middle of kind of airdrop mania in like mid 2024, there were a lot of complaints that you would get, a Solana DEX would debut a token and they would airdrop 10% to the community. And then the valuation would be in the billions. And the general meme that would go around on Twitter is like the VCs were able to buy in at a much better valuation, and now it's being dumped on retail because they're having to buy in at like a unsustainable valuation. But if you're saying that a lot of this FDV doesn't exist in the first place, like does it shift that conversation at all?
So the question is, why do people hate that token structure? And the answer is because price goes down. I think Mert and I agree with it on this one. The reason why the price went down has fucking nothing to do with the token structure and everything to do with the shitty product that got built. That's that simple. If you build a bad product, the token price will not perform well. Now, that said, there are like strange circumstances where tokens launch at way too high of a valuation and have no chance at going any direction other than down. And yes, the VCs got in at a lower price there, but like, I also think this industry weirdly hates VCs. Anyone that's worked at a startup knows how hard it is to hire really good talent when you're like pre-funding, and people are suspect. They don't want to come work for you if they think their job won't be there in 3 to 6 to 9 months. So I don't know. I also really hate the whole like VCs are the most evil people in the world. You can't blanket statement in either direction because there are bad VCs, there are great VCs too, but I think this industry really over indexes on things. And I also think those token structures get called shitty again because the price goes down. But the reality is the only way to launch with a higher float is to give away more tokens. And so you're kind of stuck in this shitty thing where it's like, it's not an easy problem to solve. You're ending up giving away more of your equity at launch. So the question really is, how do you launch at a reasonable valuation? Because when if you have if you're in let's say a crowded sector with a lot of great competition, and then you launch and you're at a multi-billion-dollar valuation, dude, it doesn't, your token will go lower. And I think just the launch strategies historically have created bad environments for this, where as you look at one of the more recent token launches, like Hyperliquid, came out at $4 and screamed to 25. That you just totally deleted that narrative, and yet you launched with a similar. I guess their launching float was a bit higher, but it's just a matter of the launch price more than anything.
To go a little further on that side tangent, which is, I think it's extremely mid to hate on VCs in crypto, where basically the source seems to be something like, well, these guys got a better price than me earlier on in larger size, and as a result, my token price will be worse as long as they exist. Something like that. But what people don't really understand about VCs is, there are bad ones. There's a lot of bad ones. There's a lot of overrated ones as well. I like calling certain VCs glorified swing traders in an office because that's generally what they do. But the good ones are actually quite good. And what people don't understand about VCs is their time horizon is very long, and their multiples expected is also very high. Like, if you're building a business that grows 2x per year, it sounds good, but VCs don't actually care about that. They care about the next 1,000x, next 10,000x, right? It's about very rapid growth. And so their time horizon is very long as a result. And so at the first sign of blood that a team goes through, some community members will just jeet right away, right? And you see this with NFTs in past cycles or any other asset like this, where the second something happens, people will go on Twitter, they'll say, oh, this token is going to shit, the founder, didn't like my tweet, all this stuff, and then they just start making up all these things, and it just keeps going down. Versus the VC is like, okay, great, I'll be here for the next 6-7 years, whatever, because I need the 10,000x to give to my LPs. And then of course the other thing, which is definitely not related to anything we're talking about, but I think I should mention it, is as an investor, people get this wrong. It is your privilege to be able to invest in a company, right? The team there is building a product, ideally, and not always, but ideally. And they are saying, hey, we want to give you a piece of this, and then we can kind of both grow. So it's this shared incentive alignment structure. But with VCs, they bring, the good ones at least, they bring a lot to the table, right? They're former operators, they were former founders, they give you all these networks, they give you branding so that you can hire other people, some security, all these different things. Versus a community member, let's say a generic community member, not everybody, is just going to buy the token and then buy another 30 tokens and then just look at the chart instead of helping the project, right? A VC, and if you're a good founder, you'll know this, which is you have to make the VCs work for you. Like, hey, I need help with this. Can you help? Here's my update, etc. And if they don't, they just will get a bad reputation and then they won't be able to invest again. And so certainly there's a case to be made that not all VCs are good and most of them are bad in my view, but I think most of anything in any profession is bad. But the really good ones, and I think Multicoin gets a lot of flack for this because Kyle just tweets aggressively, but they go to bat. Those guys, and they're not even an investor in my company, but they'll write blog posts, they'll brainstorm things, they'll give you intros, all these things, they'll challenge you, and they will actually make your company better. So that's my little spiel about VCs.
What's funny about the Multicoin stuff is every Twitter participant who's trading the coins fucking hates them, and every founder fucking loves them. I just find that that dichotomy is quite interesting to me.
It'll be interesting to see as well, if you follow just sort of mainstream business news, there's a lot of talk out there about how traditional VCs are laying off partners. It's harder to raise a new fund and all these things because venture is just getting more difficult, I guess. I'm not sure anyone exactly knows why, but I'm curious to see if that trickles over to crypto venture and you don't see the same types of like OpenSea-esque mega rounds that you saw the last major cycle. Yeah, Dan, go ahead.
No, I was just gonna say it's a good question. I don't have a great answer for it. I'm just not as quite in tune with the funding landscape.
Yeah. Well, we're having multi-coin on soon, so we'll have to get their take.
Nice. The last episode, I think it was like one of the last ones I hosted was with Kyle, and he just had that banger quote of like, I don't know, we were talking, I kind of like teed him up for the REV discussion, which bled into like, okay, well, how do you think about the context of Solana versus Ethereum with the value in the context of valuations? And he's like, oh, well, there's a $300 billion valuation mispricing. It's like, that's a banger.
Yeah, I remember you tweeting that one. Yeah. Dan, another thing I want to pick your brain on a bit is stablecoins. You tweet a bit about stablecoins, and I'm going to let you walk through the data, but there's a really interesting discrepancy between stablecoin supply, especially on Solana and other chains, if you compare that to like REV and just general sentiment. So what's the stablecoin landscape? How does Solana grow its stablecoins? And just what are you seeing there in general?
Yeah, good question. I was actually looking at the DeFi Llama data the other day. First of all, they do a phenomenal job of tracking, let's call it like real stablecoin supply. So if you just look at the token contract, you're going to see a large number. It's generally higher than the actual number of stables that are like within the chain. For example, if there's like a lock and mint bridge and a bunch of stables are deposited into that bridge, they're not really on that chain in like a practical sense, but like in a security sense, they are. So I think DeFi Llama does a really good job of that, first of all. Second of all, Ethereum's lead in the stablecoin game is like staggering. They have about $110 billion of stables. Tron comes in second at about 50 billion, and then it's like everybody else combined is like another 50 billion maybe, which is fascinating to see. And I historically looked at that as like a precursor to growth, but I actually think my framing there was wrong. The reason why I thought that was the stablecoin balance on a chain signifies the amount of value that's being like stored and held within that chain, and therefore that's the amount of value that can like pour into the on-chain economy. Then I started like peeling back the layers a bit here, and I thought it's pretty interesting that on some of these chains, there's a large percentage of the stable coins are just like sexes, like Binance, Coinbase, BitGo, etc. They're just like parking stable coins there, and as part of their like risk management strategy. And so they're user funds that are just being held there. And that kind of forced me to rethink how I'm thinking about that metric being useful for the amount of value that can pour into the on-chain economy, because a centralized exchange holding user funds on a chain, those will not join the on-chain economy. Like, it's totally dependent on what the users of that centralized exchange want to do with them. They'll have to withdraw them first and then do something. And like on Arbitrum, for example, it's about 50% of their stables are being held by Binance. It's like all their USDT there. And Coinbase is parking their users USDC on Base. That's about 60-70% of the USDC on Base is actually just Coinbase user deposits. And to be clear, like, I'm not saying there's anything malicious or wrong going on there. It's just like interesting because, again, like those will not just like up and join the on-chain economy. But from a security perspective, it is like a very useful number to be looking at. Like, that is how much value is on this chain. So that's kind of like one distinction that I've recently come to the realization of. I actually don't have the numbers on Solana, but I would assume it's roughly in the neighborhood of 50%, just given what I've seen on other chains.
Yeah, I want you to walk through that a little more, because I had the same impression, is that stablecoins are the key liquidity. It's what you trade against in terms of like trading pairs. And if you look at like total value locked on DeFi protocols, it's at the levels of 2021, but those stablecoins just never really materialized on Solana. So when you're doing, like, is Pump Fund not using stablecoins in the background, or these different, I don't know, meme coin trading dexes? Like, do you just not need stablecoins like we kind of have assumed you would?
Yeah, Pump Fund pairs everything with Solana or Sol, so they actually don't really involve stablecoins at all. But I guess like where I'm thinking of it is more on like the, it's not throwing shade or anything, but just on like the real in air quotes DeFi type activity where it's like, people actually managing their savings account, if you will, by farming yield on Camino or similar. That I think is where stablecoins are more interesting, and then obviously payments. Businesses want to be paid in dollars, like full stop, and that's where stablecoins get interesting. Or remittances, people want to store value in the U.S. dollar. That's also where it gets interesting. Solana's actually doing quite well in their stablecoin balances. On our Solana dashboard that you can check out in the show notes on the on-chain activity tab, it's at, it kind of peaked or bottomed out in mid 2023 at around 1.5 billion in stablecoins, and now it's up to just over 5 billion in stablecoin supply. So I would say that things are looking pretty strong, and it's all largely driven by USDC, which I mean, Tether is an interesting one for the folks who love the crypto lore, but I think USDC is generally viewed, at least in the West, as like the safe stable in some regard. And it's definitely good to see USDC growth. And so I would say Solana is actually doing quite well in this neighborhood, but again, I don't know the numbers. I'll pull this up and maybe shoot out a tweet on like what the ratio of Solana's stable coin deposits are to how much of that is actually just held in centralized exchanges. Again, because whatever that difference is, like that's the amount of capital sitting idle that can be deployed into the on-chain economy.
But then, Ethereum, I believe, has like 110 billion stablecoins. And
I don't think theirs is actually centralized exchange either. Like I think that is like a very impressive 110 billion.
But like ETH layer 1 usage, most weeks doesn't touch Solana in terms of like REV these days, right? So I don't know. What do you do with that?
That's a great question. I think the easy answer is it's like people do trust Ethereum. It's really doesn't go offline. It's reliable. Sure, it's expensive, but it's secure. World War III resistant argument. Everything in that realm, and it's definitely the easy answer. I don't know. Maybe the more cynical answer or whatever is ETH made a lot of people rich, and that's where they hold their wealth. But I don't know, like because centralized exchanges do have a majority of the wealth or just hold a majority of the value in this industry. And I don't believe that they're holding it on Ethereum because it is more expensive to rebalance. But I could be wrong. I really only looked at base and Arbitrum for this analysis. So I don't really know what Ethereum's breakdown is. But I for some reason, I actually don't think it's exchanges. So the question is like, why? It's a tough question to answer. We're building out a dashboard specifically centered around this as well. That kind of breaks down like what are people doing with stablecoins? Like when there is transfer volume, what's it happening between? And where are the balances actively sitting? Like, is it in EOAs? Is it in smart contracts? If it's in smart contracts, is it in lending protocols, DEXs? Like what are people doing with these things? Because I think that is where you get like the really interesting data. And you can imagine like a payments protocol or a payments app where everyone like manages their own EOA, and you'd see like all these EOA to EOA transfers, which are just like regular user wallets. And that would be like a very strong indication that people are using this for like the payments aspect, which I think is what we're all chasing.
Yeah. And another piece that'll be interesting to watch if payments take off, if like, businesses start doing money transfers with stablecoins, which like very well could happen. And you mentioned USDC as being seen as sort of the safe stablecoin in the US. Do you see a proliferation of stablecoins where, stablecoins are like a very good business model? Tether, I just looked it up. They did 5.2 billion in net profit in the first half of 2024. And all they kind of have to do is like take in deposits, issue the stablecoin, hold the deposits in T-bills, get that 4% yield, or it'll go down, but whatever it is. And so do you see like, I don't know, Revolut is launching a stablecoin. Robinhood, I think, is rumored to be launching one. Do all of the involved parties just want to launch their own stablecoin? Because it's like, why would I let Circle take this easy profit when I could just do it myself, basically.
It'll be interesting. I mean, like, look, that's PayPal wanting to get their ring and their hat in the ring for the same reason. You could probably see an end state where everyone's got their own stable. I remember when Curve and Aave were launching their stable coins. Gosh, that was probably a year and a half ago now. Like, the talk of the town was protocol specific stable coins. Everyone is going to do it because it is such a good business model. Fast forward to today, and I think Aave and Go are doing like okay, but somewhere around 100 million in supply each, and it's like not bad by any means, and it's making them a lot of money, but they're not like massively scaled out or anywhere near the backing of like DAI or some of these OG stablecoins. So I think you could probably see an end state where everyone kind of wants their own stablecoin, but you could also see a different world where the market forces kind of push back on that business model being so good. And, imagine a staked USDC where you earned, 75, 80, 99% of that yield, and Circle just kept the rest. And then in that case, it's not a good business and there won't be that many of them because you'll need the size for it to be profitable.
Yeah, like many things in life, it's probably easier said than done with that. But yeah, I mean, I'll be interested. Why not credit card stable coins? It kind of makes sense with how they run these little circular economies themselves.
Yeah, I don't know if you guys read the Multicoin. I think it was like their 25 theses for
the frontier ideas.
Yeah,
right? Yeah.
I don't know if you already talked about this, and I'm sorry if you did, but I thought the buy now, pay never thing was pretty interesting. Obviously, buy now, pay later got really popularized last 2 years, I would say. But they had this idea where you do buy now, pay later by basically staking your, let's say, wrap SOL or your stake SOL. So I deposit my H SOL with a provider for like I think they use the example of Dune Analytics. So I'll deposit them with some lock period so that the yield from my H SOL will pay for my subscription. Which I thought that was actually fairly interesting. I don't know if Dune or whatever the business on the other end, like, is that interesting to them? I don't know, but we're definitely trying to get more creative with how we turn these payment rails into popularized payment methods, because that way, like, the user still gets their upside on their asset that has, people treat these assets like religions and nobody wants to sell these things. So that's like an interesting way to make them a little bit more productive, actually.
Yeah, I hadn't gone through those yet, but buy now, pay never is very snappy. I'm a fan. Dan, I'm going to throw a compound question at you and you can answer whichever one you want, dealer's choice here. But I've been interested lately, and I know we've texted a little bit about conditional liquidity, which is this new sort of trading structure put out by DFlow, which is like a Solana swap platform. So I'm curious if you've looked deeply enough into conditional liquidity, like what you think about that as a potential solution to some of the issues with toxic order flow and sandwich attacking. And if you don't feel like you're there, just what do you make of a lot of the recent dialogue surrounding MEV and sandwiching on Solana?
I'm glad you gave me a two-part question because I think DFlow is really, really interesting. I don't have a deep enough understanding to give you like a educated answer here, but what I will say is it's good to see the Solana DEX landscape, let's call it, evolving into different and new not use cases, but just like market structures. They've created basically this segmenter role, which basically splits flow between toxic and retail flow, and basically will quote different spreads for that. That's pretty interesting. Market segmentation is very useful, and that gets me excited. So the question is like how popular it will be. Well, it's hard to say. Like I think if you look at it, it's hard to compare like Ethereum to Solana when it comes to trading, just because the market structures are so different. Where 12-second block time versus 400 milliseconds is already like breaking change, and then the block builder landscape is so different on both. It's very hard to compare like this level of analyses. But CowSwap has pretty strong or pretty effective ways to like mitigate MEV, get better trade prices, et cetera, et cetera. And it does like a good amount of volume, but I don't think it's like the majority of volume on Ethereum. And so like DFlow and CowSwap are certainly different, but directionally, I think they're trying to do similar things. And we've also seen Camino initiate limit orders as well, which is another good way to kind of help users mitigate some of the harmful harmful MEV when you're trying to get a specific price and you're less concerned about the time to execution. So that's kind of what I'd say about the first piece. And on the second piece, I mean, I'm really excited to read the piece Helios is putting together around this. It should be like a super deep dive on the topic, but directionally what I would say is front running is horrible. And anyone who says otherwise is lying to you or just unaware of how bad it is. You should not, if somebody sees your information before it has impacted chain state, like that is a problem. And it's going to be solved, right? People are working very, very hard for that, but that's like a leaky transaction pipeline problem. So I don't know. I find that piece kind of interesting. And it's hard to, again, I feel like I haven't done the more rigid analysis on this on the data side yet because we don't have the data infrastructure to support it, but that's what we're building out. But very excited to get there because I want to quantify this exact problem, which I just haven't had the opportunity to do yet. I've like poked through the Explorer, obviously, and like there's one contract, VPE, that runs most of the sandwiching. And it's kind of like all over the place on its profit margin. Like some are this huge profit margin, some are quite small. I don't know, like loosely looking at transactions, it looks like it's north of 50% margin, which if you look at the largest sandwich bot on Ethereum, Jared from Subway, his margin is 5%, which is a huge difference. And so REV is significantly less impacted by the presence of sandwiching on Solana because of that change in margin. And for one piece there, and then two is users are still equally as screwed because they got the same price execution, regardless of the searcher profit margin. So I think there's going to be a lot of improvements coming to that, but part of it's like twofold. One is like, how do you fix this leaky transaction pipeline on the Solana side? And the other one is how do you build better market structure on the DEX side to mitigate the opportunity for some of that to exist?
Well, yeah, because the difference there with the Jared from Subway on Ethereum comparison is just that with ETH fees being what they are, you have to have a massively profitable sandwich attack to make it economically feasible. Whereas on a cheap chain, any sandwich almost could work out to be profitable. I actually saw a dashboard that like only 70% of Solana sandwich attacks are profitable, which I found kind of interesting. Like people are doing this and still losing money, but that's just the general gist of why it's worse maybe on Solana than Ethereum, right?
Yes and no. I mean, like you can think of okay, so yeah, you're right that Ethereum is much more expensive to transact on, obviously, right? It's like multiple dollars right now. I think gas price is 10 gwei, so a swap is like $15. Let's say that there's like equal opportunity on both chains where there was $100 arbitrage or sandwich attack opportunity. Like, so that's after you factor in gas price and all of that. Basically on Ethereum, to win that transaction, you're going to have to bid $95 of a tip, whether it's priority fees or using MEV boost, for your transaction to get taken by the builder, or else like somebody else will bid higher than you, basically. Whereas on Solana, because of the private mempool being used and then the transactions getting leaked into that and only one person seeing them, which is this VPE contract, you can bid, $50, $40, $30, and you're still going to win it because there's no competition to play against you in this game. So the user still loses that $100. It's just a question of who gets the profit between the validators or the searcher.
There actually is some competition coming up now based on some look at the numbers. I believe that person is now 50% of all sandwiches, but there are a lot of other ones popping up. And also, we did the math on this, and that'll be in the report Dan mentioned. And it seems something like the stake will, if at the current rate, would grow maybe 0.2% per year. And so perhaps the centralization concern was a little overstated, but we'll see. Obviously, it depends on multiple variables, which are not constant in any way over time. But we will also, a little plug here, the Helios Explorer will have a swap function, which will use a deflow thing. the conditional swap, the conditional liquidity swap, or actually it's called declarative swap, where the trick is basically like Dan said, if it's retail flow, somebody attests to this and says it's retail flow, and so that's a different spread or quote than if it's Citadel. And so we're going to experiment with that and see where it goes. And then Jito is also doing a bunch of stuff in the background to improve how this works. And so it should be interesting to see how this plays out in contrast to Ethereum. I'm very curious to see like this conversation be had again in 7-8 months.
There's a question I have for you as well, Mert, of just something I've been thinking about a bit recently, which is you'll get these tweets that get a lot of traction about the sandwiching problem on Solana, and it's often accompanied by, this is a really big problem and my project is solving it by XYZ means. So there's a little bit of like a business motive for them to be convincing people that the sandwiching issue works this way and it needs to be solved in this particular way and everyone should use their protocol and so forth. So just in your view, having looked into this, how much of the sandwiching discourse that exists out there do you think is kind of self-serving among the people that are posting about it?
That is quite spicy to comment on, I think, but it's somewhat of a self-fulfilling prophecy, because assume you actually think it's a problem and you think it's the biggest problem. You're concerned about it. As a result, what will you do? Well, you'll build a product around solving it. But then if you've done that, then you're going to say, well, we built this because we think it's the biggest problem. And as a result, we're now going to talk about it. And so that's fair. The insidious side of that, of course, is we built this product and it solves this thing. Now, this thing I'm going to scare you about so that you're also against it. And then now you have to use my thing. That's also possible. But I tend to think that most people on Solana, especially the ones who have been here for a while, are of the former group where they actually think it's a concern. And so they just make a market assessment on the gap there, and then they try to solve it, and then they talk about it. So I think that's fair. I do think naturally, just due to how humans function, it will go both ways. Like, you will make it a bigger deal than it is just so you can get some traction, but also you are probably concerned about it. It does seem, and this is where data comes in helpful, where if we can actually get the data, we can make somewhat of a more or less emotionally charged decision on, okay, is this actually a huge problem, or is it a medium problem? Is this a problem in 10 years, right? If the stake is growing by 0.2% and it's getting more competitive, then perhaps it's actually not so centralizing, but maybe it has a potential to be, right? If somebody even more competent comes in. And so I think it's very hard to answer. But that being said, it's probably better, somewhat at least, to a bit more alarmist about it early on so that you can get all these solutions out. So sandwich resistant AMMs, conditional liquidity, perhaps a different block engine thing, MCP, all these different things. And then maybe you play them out in production and then be like, okay, well, this one works the best. And so if this problem does become really bad, then we have the market data here and this is what works and we'll use it.
Yeah, I actually think it's a great answer. And I feel that way about a lot of things, like, not to go off on a huge tangent here, but people also roast VCs for, talking about their bags all the time. But I'm like, okay, yes, there's obviously a harmful or inappropriate, I guess I'll say, way to do that. But like, if you have an idea and then you invest in that idea and then you continue to talk about that idea, like, dude, no fucking shit, you're talking about that idea. So, side tangent. But Mert, I got a question for you about the sandwiching stuff more broadly. Like, what does it look like? There's been so I guess on the competition side, let's say 3 months ago, 4 months ago, when there was no competition, it was like one private mempool that validators were leaking transactions to. And this person was like, advertising that, hey, I'll run your relayer. And then that relayer was basically just dumping the transactions into this mempool. is there basically like someone else who saw that and was like, huh, that seems like a great idea, I'll go do the same thing? Or like, how do we think that that second party is getting their transactions?
There are a bunch of theories around it. In fact, I was talking to Lucas, who's the CEO of Jito, and it seems like there's a new type where they don't even use Jito, and they don't even, what was it? It's just a totally bizarre setup that does not, that is, well, you can detect it, but it doesn't use the regular Jito auction, and all. It starts getting super weird with this MEV stuff. Now, how are they getting those transactions? Well, I think there's multiple ways to do it, but obviously one is a custom client or like a slightly modified client. Let's say it's a Jito client, but with a slight twist, and then you get some money from somebody else, and then you have enough stakes such that Turbine, you see some of these shreds before they happen or before they're confirmed. And perhaps you also have a deal with another RPC provider, or perhaps you are that RPC provider. I think there is a shady RPC provider on the network who does sniff those, to be completely clear, and it's not any of the usual suspects that you would think. Like, it's not us, Triton, or QuickNode. So just to be safe there. But some of these sketchier teams, generally in the form of NFTs, right? That's a very common strategy where the RPC node is gated by an NFT that you bid like $200,000 on, and so be careful of that one. But and then the problem is, of course, as soon as you detect it, then they just change it. And I remember back in the day, somebody forked Jito, and then they were trying to get people to run those as well. There's some other side deals, and it's very hard. And that's why, it's not completely why, but it's also why putting things in protocol is going to be a better answer going forward. So like reducing or removing the burn with SIMD 96, such that the side deals do not happen off chain, and you can actually at least tilt the scales towards seeing it on chain. But I would say Jito's pretty on top of it. That's not a team that I would want to play a cat and mouse game with. But we will, that report, we're just getting some comments from Ellipsis, Jito, DFlow, etc. internally, and should be live hopefully early next week.
Awesome. Yeah, pumped for that one. That's super interesting. Like, is there like on the solution side of this, like how do you prevent validators from, malicious validators from seeing transactions too early? Like, that seems like an incredibly hard problem to solve.
Yeah, I think, well, one, it depends on the actual problem, which I don't think we've quite identified, at least in terms of a definitive answer. But the life cycle of a sandwich, let's say, is multiple parts. I mean, one is seeing the transactions, but then one is actually being able to structure them and then send them and then profit from them, and then the value share structure from that. So there's multiple parts to it, and it's unclear which part that you interfere at or try to solve the problem at. And I would say I don't hate the Ethereum approach of just democratizing it basically such that there's maximized competition. I think that's a good way. But then that's probably coupled with app level mitigations such that the user intent is actually encoded into the transaction. And because, I mean, to be clear here, sandwiching is a bad problem, especially in two ways. One, obviously, being a malicious price execution for the user. There's obviously also legal elements, like the TradFi guys would they know what front running is. That's a very common thing, and so they don't want to see that on decentralized networks. But then the other one is so the centralizing effect is one, or no, I said the price execution being bad is one, but then the bigger concern is probably the centralization of the network. And it seems like the enabling a public mempool helps decrease that concern, but it seems like that's actually not too much of a concern today. And so then what happens is you look at the data, and I mean, anybody who's traded on Solana knows this. The people who get sandwiched are the people who use a TG bot on 800% slippage because they think the price of the coin will go up 5 billion thousand X. And as a result, they don't care about being sandwiched for, let's say, 30%. And that's the game they play. It's like they're playing a casino game where it's rigged against them, but like they do it willingly because they like the casino. That's unfortunate, and I'm not sure the like any sort of validator level thing fixes that. And I think at that point, only an app level thing fixes it, where the app actually has to care. And so that's why I think like the sandwich resistant AMM, but also the conditional liquidity stuff will be pretty interesting. So we're gonna play around and see, like, once we release this Explorer, do people actually give a shit about this? Like, do they actually care about doing swaps without getting sandwiched and just by using user intents instead of like bundles, for example? So it's very hard to say. MEV is a very annoying problem.
Yeah, my guess is that retail generally doesn't. Like, I don't know. I've traded meme coins when I'm trying to get that fill. Dude, slip me to hell. I don't care. That's like, to your point, I'm getting that 10x, no questions asked. So I don't think retail really does, but like, yeah, I do think professional traders do that are moving significant size through blockchains, or people just running Sextex ARP. Like, you definitely care the price you're getting because that's the whole game.
The other thing I'll briefly mention is like one of the core problems here is the delay, that where you get a quote for the price of the token that you're going to execute on versus the time it takes to land. And then what happens in that time? If the price moves, then obviously it's not going to execute. And so you're going to increase slippage. And so Alessandro, who's a lead core dev on Anza, he discovered a lot of like transaction sending pipeline inefficiencies. And it's also very unclear to me, and I think this is like a very unspoken piece, but once the transaction pipeline stuff is ironed out such that the latency between getting a quote and then actually executing on that quote on chain by landing the transaction, once that's much better, and I think there's at least a 2x improvement there to be made, I wonder how much that reduces it. Because like today, our median land time using our staked connections with Helios is like 0.8 seconds, which is just twice one block, right? And he actually says that lines up perfectly because during the second half of what the leader does, it's complete waste. It doesn't do anything. And so if you remove that, or if you optimize that, and let's say your land time is now one slot, 400 milliseconds, well, then sandwiching becomes much harder anyways. And then you can actually reduce the slippage. And so there's a lot of engineering inefficiencies to be worked out there still as well. And those will be worked out.
I was going to ask you about that exact tweet exchange after the pod, so I'm glad that came up. Yeah, I think the other thing he said there is like, wow, this bug actually aligns up, and this makes sense. It's not something you get a lot around here, which is pretty funny. But I think, first of all, agree totally from a high level of everything you just said. Sandwiching is bad and needs to be mitigated. But I get in this debate with Ryan Connor from our team quite a bit, and he has like a decent list of empirical evidence where obviously front running is bad, but it hasn't stemmed growth. So like TradFi markets on the equity side had a broker front running issue until the late 80s. And obviously they still grew to the size they are today. And also at the time, still won market share from the UK. Front running has in no way also stopped Ethereum and Solana from becoming where they are today. And yet it exists on both of those chains. And even if you look at L2s, which do not have front running because of the single sequencer architecture, Ethereum and Solana still do more volume on most days than, let's say, Base or Arbitrum. And there's even back on the TradFi side, IEX is like specifically designed to limit the information advantage of HFTs, and it's still never achieved more than a 4% market share of US trading in the decade that it's been alive. So there is also a lot of empirical evidence to say like largely people aren't like extremely averse to front running, even though you look at it and it's like, yes, this is obviously bad. So I don't know. That's just like another interesting angle to look at it from. He's like the one who brought that to my attention. I do think it's like interesting perspective.
The final angle I'll put on this to scare some of the people listening, if they are protocol operators, is there's also a legal side to this, right? TradFi people, governments, regulators know what front running is. This is something that exists. It's looked upon as being illegal in many jurisdictions. I believe Europe basically just try to just say MEV is straight up crime. And I forget the exact language there, but people really are against this on a regulatory aspect. And yeah, Trump got elected, but like nobody is going to be okay with front running and basically robbing retail. And so perhaps if you're working on something where you are basically negligent towards users getting front run, I would perhaps consult with your company counsel, because if you're like willingly not doing anything about this such that your users are getting front run, I'm not saying you'll get in legal trouble, but I'm saying it's certainly a possibility. And actually, if you raise, again, VCs might ask about this while doing due diligence, because like it's just straight up illegal, like in traditional market structures, in many cases. So I would be very careful of that, and I would try where you can at least to see how you can mitigate this at the app level.
Yeah, not legal advice, of course, just a legal nudge, maybe. But that is all the time we have for today. It's been a really fun conversation, Dan. It's always good having you on. I really appreciate you taking the time, man.
Yeah, Mert, Jack, been a pleasure. This was a fun one.
Absolutely. We'll see you all in the next one.